Hello and welcome back to Module 3 of the Stock Market Masterclass, Portfolio Construction. In the second part of the Portfolio Construction module, we will look at some ideas on how to construct an investment portfolio and how to use asset diversification to minimize risk. In this lesson, you will learn how to construct an income-focused investment portfolio. You will learn how to diversify an income-focused portfolio with a conservative growth component. You'll learn how to construct a growth-focused investment portfolio. And finally, you'll learn how to diversify a growth-focused portfolio with a moderate income component. Constructing a portfolio that meets the requirements of an investor is a very important part of building wealth. Portfolio construction is essentially grouping together financial products that can effectively work towards achieving the financial goals of an investor. The most important step that needs to be taken before the construction process begins is determining an investor's risk profile, as this is what the construction of any investment portfolio is based on. Although extremely important, we will not focus heavily on risk profiling here, as this is not the emphasis of this section and is beyond the scope of this course. As this module is based on portfolio construction, we will look at the two types of portfolios that investors generally want to construct: income-focused portfolios and growth-focused portfolios. Let's first look at income-focused investment portfolios. Portfolios that are constructed with income as the sole focus will generally maintain steady performance in nearly all market conditions. These types of portfolios are suited to investors who have an extremely low appetite for risk and are satisfied with consistent income that is relatively very conservative. This type of portfolio is considered extremely defensive, with very low risk of capital loss, and as such, will contain a portion of all the asset classes discussed in the previous section under the defensive banner. To break down the different allocations for the portfolio construction, we will use percentage values for each. These percentages can be increased or decreased according to the investor's comfort level and are suggested only as a guide. The three asset classes that are suggested for this portfolio are a cash holding, term deposit investments, and government bonds. The chart that we can see on the screen demonstrates the type of breakdown that can be used for each asset class. Let's now look at income-focused diversification. As you can see, the largest percentage is allocated to the Australian and international government bonds, making up 50% of the portfolio. Australian government bonds are considered highly secure investments, where the government will pay the interest on time and return the principal on maturity. Over the longer term, government bonds have returned an average of 5 to 6%, but the returns vary on the current economic climate and interest rates. International government bonds are also included to help reduce country risk from the portfolio. The second largest allocation are term deposits. You will remember from the previous section that the Australian government guarantees term deposits up to $250,000 held at authorised deposit-taking institutions. This is also a highly secure investment product, especially if the amount of the investment is $250,000 or lower. The trade-off is that the interest rate is generally lower than bonds and varies according to the current Australian interest rate. The third and smallest allocation is a cash holding. This portion is expected to return little, if any, return when held in a bank account, but should be included for the sake of diversification and access. As an example, investments in term deposits and government bonds have a set period of time for investment. If for some reason an investor needs to access their funds at short notice, breaking either of these terms could result in a financial penalty or loss of interest payment. By maintaining a cash holding, funds can be accessed instantly in most cases when required. Let's now look at income focused with conservative growth investment portfolios. Portfolios that are constructed with income as a primary focus, with some expectation for capital growth, can include some other asset classes that can facilitate this from the growth assets category. This type of portfolio is still considered mainly defensive, but the addition of some growth assets does increase the chances of some capital loss, which is a trade-off for conservative growth potential. To break down the different allocations for the portfolio construction, we will once again use a percentage value for each. These percentages can be increased or decreased according to an investor's comfort level and are suggested only as a guide. The asset classes from the defensive category that are suggested for this portfolio are a cash holding, term deposit investments, and corporate and government bonds. From the growth category, domestic equities and real estate can also be included. The chart on the screen demonstrates the type of breakdown that can be used for each of these asset classes. As we can see in the chart, 3/4 of the asset allocation contains assets from the defensive category, with the inclusion of corporate bonds. Quality listed company bonds generally provide a better return than government bonds, but are still considered lower risk investments than company shares. Using these asset classes helps protect the portfolio from market volatility, but still provides a steady income stream for an investor. The next largest portion is allocated to domestic shares. As noted in the previous section, domestic and international shares also provide a form of income through dividend payments and franking, so they are a welcome addition to an income-focused portfolio. However, the main benefit of adding shares to the portfolio is to gain exposure to potential capital growth to the value of the shares. Now, although this increases the potential for capital losses, the allocation size in equities for this type of portfolio is balanced with the defensive asset class element, so any negative volatile fluctuations in the market will have a minimal effect on the value of the portfolio. The benefit of share income is also important here because, almost like a limited hedge, the shares can fall in value the amount of the dividend payment and still have little impact on the overall portfolio value because of dividends. This gives investors the opportunity to potentially capture capital gains with some protection provided by the dividend payments. The smallest portion of the growth assets classes are the REITs. Like shares, adding REITs to the portfolio also has the added benefit of an income-producing asset with the potential for capital growth. As I discussed in the previous section, REITs and shares aren't directly correlated to each other, meaning that by adding both asset classes to the portfolio, a volatile market will not automatically affect both assets in the same way. Both can be expected to provide income by ways of dividends, but the capital gain or loss component can operate independently of one another. It is quite feasible for shares to incur a capital loss for a period where property remains steady or rises in value, adding further diversified protection to an investment portfolio. Let's now look at growth-focused investment portfolios. Growth-focused portfolios are suited to investors who have a very high appetite for risk and are very aware that the larger growth potential does come with higher risk. Portfolios that are constructed with a growth-focused mandate are much more likely to capture large market runs when a trend is in place. This comes with the trade-off that when a market downturn occurs, a growth-focused investment portfolio is far more likely to reduce in capital value, as many of the drivers which help the portfolio grow in an uptrend also drive the markets down. As you have probably guessed, a growth-focused portfolio is going to be made up of growth asset classes like domestic and international shares, commodities, and real estate. The share market has a history of driving economic growth, and a portfolio that is centered on growth should have significant weighing in this asset class. It is important to remember that some of the biggest rises and falls in economic cycles were driven predominantly by shares or housing, so growth potential does come at a significant risk at times when the economy is weak. The 4 asset classes from the growth category are suggested for this portfolio, which include real estate and commodities, with the remaining portions allocated to domestic and international equities. The chart that we can see on the screen demonstrates the type of breakdown that can be used for each of the asset classes. As we can see on the chart, a large section of the portfolio is allocated to domestic and international equities. The reason why this allocation is the largest relates to the fact that they contain a good income component through dividends. Not only do dividends provide a regular source of income for investors, but they also provide a small hedge in weak market conditions. As an example, if a share pays a dividend of 7% per annum, and over the course of a year, the share drops in value by 6%, all things being equal, an investor will still be up 1% overall for the year on that share. It is important to keep in mind that investing in a country's index, such as the ASX 200 or the S&P 500, through the use of an ETF, can still be classified as part of this asset. Indices are a great way to gain exposure to the share market without the risk and effort required to identify individual shares and sectors, and still comes with the benefit of regular dividend payments to the investor. As I mentioned in the previous section, a rising share market generally bodes well for property, as rental incomes and capital appreciation in the underlying assets tends to increase. The capital growth component of this asset class doesn't historically perform as well as equities, but is slower in reversing at a peak of a market, so this adds some protection to an investment portfolio in an aggressive market shift. The income component of a REIT also helps add some portfolio protection during negative periods, for the same reasons discussed earlier in the equity section. The final asset class included in the growth-focused portfolio is commodities, and this is due to their consistent performance in multiple market conditions, including downturns. The demand for some commodities does not waver due to a falling share market, bringing extra diversification and protection to a portfolio with a heavy weighting of equities. Although diversified, it is very important to understand that this type of portfolio is considered extremely aggressive, as it does not contain any defensive asset classes. Only investors with an extremely strong appetite for risk may be suited to this type of portfolio construction, as large drawdowns should be expected over time. Let's now move on to growth-focused with moderate income investment portfolios. Growth-focused portfolios with a moderate income element are suited to investors who have a high appetite for risk but require a steady flow of income, which helps reduce some of the risk. Portfolios that are constructed with a growth focus and income mandate are likely to capture large market runs when a trend is in place, but continue to provide an income for investors during flat periods and times of market weakness. This type of portfolio is going to be made up of mainly growth asset classes, like domestic and international shares, commodities and REITs, with a mix of government and corporate bonds to increase income potential without increasing the risk. The chart that we can see on the screen demonstrates the type of breakdown that can be used for each asset class. As we can see on the chart, the amount of domestic and international equities has been reduced to include the use of government and corporate bonds. Adding the defensive asset class to the portfolio serves as a protective mechanism in an aggressive falling market due to the reduced exposure of equities, but still provides a form of income in all market conditions. The exposure to commodities and REITs are included to help mitigate some of the risk, but not limit extra sources of income that the portfolio can provide to an investor. This type of diversification allows the portfolio to continue to grow effectively in a bullish market, whilst providing a steady flow of regular income from all the asset classes. In flat or sideways markets, the diversified mix of the asset classes continue to provide income, while commodities and REITs may still provide capital growth during flat periods for equities. Finally, in a bearish market, the income from the asset classes would be expected to continue, while the asset classes like government and corporate bonds, as well as commodities, will help mitigate the downside risk that equities and REITs may be exposed to. Now, you must be aware that although this portfolio is diversified through the use of multiple asset classes, it is still considered an aggressive portfolio due to its high exposure to growth assets. Only investors with a strong appetite for risk should consider this style of asset allocation, as large drawdowns are still likely over time, even with the increased amount of regular income to help offset it. It is important for investors to continually monitor and review the asset classes in their portfolio on a regular basis. Almost like fine-tuning your investments, ensuring you have the right mix of asset classes to meet your ongoing or changing financial requirements is a vital part of any successful investment strategy. In this lesson, we have learned how to construct an income-focused investment portfolio. We learned how to diversify an income portfolio with a conservative growth component. We learned how to construct a growth-focused investment portfolio. And finally, we learned how to diversify a growth-focused portfolio with a moderate income component. This concludes Section 2 of the Stock Market Masterclass, Portfolio Construction. We thank you for taking this journey with us, and we hope that the information that you have learned in this masterclass will enable you to build a better performing portfolio that is more tailored to your financial needs.